Hi everyone, I hope you're all doing wonderful today. I'm the Portfolio Panda. We as humans, or pandas in my case, are emotional and irrational things. The topic of behavioral finance is a well-researched topic where people can spend entire careers. I'd like to cover a few of the basics to help you perhaps step back and have a think about why you are choosing the investments you are choosing. Some of the factors that can influence our financial behavior are herd behavior. Herd behavior states that people tend to mimic the financial behaviors of the majority of the herd. Herding is notorious in the stock market and can be the cause behind dramatic rallies and sell-offs. Emotional gap. The emotional gap refers to decision-making based on extreme emotions or emotional strains such as anxiety, anger, fear, or excitement. Oftentimes, emotions are a key reason why people do not make rational choices. Anchoring. Individuals tend to fixate on a target number or value, usually the first one they get, such as an expected price or economic forecast. I know that I'm guilty of this one. Self-attribution. Self-attribution refers to a tendency to make choices based on overconfidence in one's own knowledge or skill. Self-attribution usually stems from an intrinsic knack in a particular area. Within this category, individuals tend to rank their knowledge higher than others, even when it objectively falls short. For example, someone who works their whole life in a construction company may not be the best stock picker for construction companies, but given the amount of knowledge about the job that they have, they may think they are qualified to make these kinds of predictions with ease. Understanding investor behavior. When it comes to money and investing, we're not always as rational as we think we are, which is why there's a whole field of study that explains our sometimes strange behavior. Regret theory deals with the emotional reaction people experience after realizing they've made an error in judgment. Faced with the idea of selling, investors become emotionally affected by the price at which they purchased a stock, so they avoid selling it as a way to avoid the embarrassment of having made a bad investment. Some investors avoid the possibility of feeling this regret by following the conventional wisdom and buying only stocks that everyone else is buying, rationalizing their decision with everyone else is doing it. Strangely enough, many people feel much less embarrassed about losing money on a popular stock that half the world owns than about losing money on an unpopular stock. People get optimistic when the market goes up, assuming it will continue to do so. On the flip side of this, investors become extremely pessimistic during downturns. A consequence of placing too much importance on recent events while ignoring historical data is an over or under reaction to market events, which results in prices falling too much on bad news and rising too much on good news. Understanding some of the reactions you might have to market behavior is one way of trying to manage them, but it's hard to control when it's happening to you in real time, as I'm sure some of you are already aware of. Studies have shown that people suffer almost twice as much pain losing $1 as they would feel happiness in gaining $1, and this is something that motivates investors to hold on to losing positions rather than selling to preserve their money. Okay, thanks for the lesson on psychology, Mr. Panda. I hear you saying, but how can this be applied to me in my life? Glad you want to know. Are you emotionally attached to your investments? Having a company that you really believe in is great, but if you become too attached to your stocks, it may cloud your judgment. When you are emotionally attached, you may ignore your money management rules or ignore negative information that the market is telling you about a position. What losses are you prepared to take? Accepting that losses are inevitable is a bitter pill that we are all unfortunately forced to swallow. No one likes it, but that's life. Determine and accept your maximum loss amount as you enter an investment. Make sure this amount is an amount you can lose without affecting your lifestyle. Are you searching for an investment guru? Maybe I'm shooting myself in the foot a little here, but people tend to move from finance channel to finance channel looking for the next big investment guru that's going to change their life. There's no perfect set of rules to be successful in investing, and most of these books and videos should be treated as a guide only. As usual, let me know any questions in the comments below and make sure to share this with your least financially savvy friend, then tell me if I did okay at explaining the topic. Your most valuable asset is your time. Thank you for sharing yours with me. Until next time.